Minasan, konnichiwa, Zamurai Engineer desu. In this video, let us continue to discuss analysis and usage of cost behavior. We have the learning objective in this module, number 6. Prepare income statement using both variable and absorption costing. Okay. Variable costing, our overhead cost that will be included is only the variable overhead. Okay, that is the difference of absorption and variable costing. So let us prepare the income statement. Income, absorption, and variable costing. Let's assume the following information for the company. 20,000 units were sold during the year. So this is the company that we are talking about. These are additional information. 20,000 units were sold during the year at the price of $30 each. There is no beginning inventory, so zero. So now let's compute net operating income using both absorption and variable costing. So absorption costing. So we have the income computation format. Okay, so this is the format. Let us start with the sales, for which we were able to sold 20,000 units for $30 each. So 20,000 times 30, that is $600,000. Less cost of goods sold. This is absorption. So this is the one we are using in financial statement. So we are using cost of goods sold. So what are the cost of goods sold? Beginning inventory, add cost of goods manufactured, goods available for sale, ending inventory. So you can get the total of goods available for sale and the ending inventory. That is what? 480,000. Okay, 480,000. So 600 400 minus 80,000, that is 320,000. Okay, so goods available for sale. So the cost of goods sold are the how many are the goods sold? What are the cost of that? So the cost of that is 400,000 minus 80,000 because there is an inventory remaining in our warehouse. So only 320,000 was sold. The remaining 80,000 is inside our warehouse. So 600 minus 320, that is 280. So that is now our gross margin. So if you less the operating expenses, which means the selling and admin expenses, which total to what? Variable selling and admin expense, that is equal to 20,000 times 3. And fixed is 100,000, so 160,000. So if we subtract this from gross margin, we have what? Net income of 120,000. That is our absorption costing method format. Okay. What about for variable costing? For variable costing, the same amount of sales. And you can observe Our net income using absorption is 120. Now, our net income is only 90 by using variable costing. Okay. So why? Because we have the same sale, but we have to less the variable expenses in order to be able to find the contribution margin. Contribution margin is equal to sales minus variable expenses. What are the variable expenses? So the variable expenses are the variable cost of goods sold and variable selling and admin expenses, which total to 20,000 times 3, that is 60,000. So 60,000 plus 100,000, that is 260,000. That is our variable expenses. How can we get to the variable cost? How to calculate that? Because we have to add the beginning inventory, how much we had in the previous accounting period. How much? The given is 0, so we do not have anything. We have to add the cost of goods manufactured. That is by using variable unit cost, which is $10 times 25,000, that is $250,000. So $250,000 plus 0, that is $250,000. That is our cost available for sale. Okay, because 250,000 is the amount of goods manufactured. We do not have inventory previously, so the goods available for sale is also equal to $250,000. Now let us subtract the ending inventory remaining in our warehouse. That is what? 5,000 times $10, that is 50,000. 250 minus 50, that is 200. That's how we come up with the variable cost of goods sold, 200. Plus the variable selling and admin cost, 60,000, so 260,000. So we have 260,000 that must be subtracted to the sales in order to get contribution margin. So we have 340 contribution margin. And if we subtract the fixed cost, okay, which involve what? Manufacturing overhead and selling admin expenses. Okay, so the fixed cost under the manufacturing overhead and the fixed cost under selling and admin cost. So 150 and 100, if you add, that is 250. So 340 is our contribution margin minus 250. The result would be $90,000. So that is our net income. And this net income is less than the net income we computed using the absorption method. Our net income there is $120,000. Extended comparison of income data. Here is information about the operation of Harvey Company for the second year. Number of units produced, 25,000 pieces. Number of units sold, 30,000 pieces. Units in beginning inventory, 5,000. And unit sales price, $30. Variable cost per unit, direct materials, direct labor, variable manufacturing overhead. Okay, so per unit, we already computed as 10. Selling and admin expenses, 3. What about for fixed cost per year? Manufacturing overhead, fixed, selling and admin cost, 100. So 150, 100, total is $250,000 cost, fixed cost per year. So let's continue. Unit cost computation. So if we compute that, we can return back to our previous slide. We already explained this. Since there was no change in the variable cost, okay, per unit, variable cost per unit, total fixed cost, or the number of units produced, the unit cost remain unchanged. If there is no change in variable cost. Okay. So the unit cost remain unchanged. So 10 is equal to 10. Remain unchanged. Take note, we do not have variable cost per unit, total fixed cost, or the number of units produced. So what about absorption costing? Sales 30,000 units times $30, that is 900,000. Less cost of goods sold. Take note again, 5,000 times 16, because 10 plus 6 is 16. That is our calculated value. So 5,000 times 16, that is 80,000. Let us add. This is for the next period because previously we do not have beginning inventory, but now we already have because this is the next period. 25,000 times $16, that is 400. So therefore, cost available, goods available for sale amounts to 480. Less ending inventory we do not have, meaning we were able to sell all of the products. We are able to sell all of the finished goods. So 0, and therefore our gross margin is equal to sales, which is amounting to $900,000, and cost of goods sold is amounts to $480,000. So 900 minus 480, that is 420. To less selling and admin cost, which include variable and fixed selling and admin cost. That is what? $90,000 and $100,000. So $420,000 minus $190,000. That is $330,000. That is our net income. These are the, what is the note? 25,000 units produced in the current period. So that is a given, no? Or data, so measured data. Okay. Again, we have the following information from the previous example. We have what? Variable manufacturing cost only, which is what? And then another one is fixed manufacturing overhead. So variable, all of those things are variable. Starting from beginning inventory, cost of goods manufactured, cost available for sale, then what? Variable cost of goods sold, variable selling administrative expenses. So those are the variable manufacturing cost only. How about fixed manufacturing overhead and fixed selling admin expenses? We'll just use from the example data $250,000. Therefore, we can subtract 250 from 510. The answer is 260. So we have this value. Any question? Any one who would like to ask? If there's none, thank you very much for listening. This is Dr. DrEYPEI again, teaching engineering for nation building.